Major banks getting out now. We need physical silver. These banks are dumping their risks and showing silver stackers that this unforeseen shift is sending us into the same situation we had for the great financial crisis. This is frightening, and dumping their risks will change silver in a big way. This is from Bloomberg, and the headline reads, JP Morgan risk swap ends up at a familiar place, rival banks. SRT trades are meant to shift loan risks out of the banking system. I know that is a mouthful. We as silver stackers, we're not as fluent in the world of banking as we are with precious metals. So I'm going to help you understand this because this directly impacts our price of silver. Again, it says SRT trades are meant to shift loan risks out of the banking system, but the use of leverage by buyers of the complex securities is calling that into question. And this article starts by saying, when JP Morgan Chase arranged a series of trades to shift the risk of losses from $20 billion of its loans, some of those dangers wound up at a familiar place, rival banks. So what happens is large banks like JP Morgan Chase, they have risky loans and they try to get rid of them. They often move to hedge funds and try to convince hedge funds to take these. But what's happened is rival banks are taking on these debts. Let's keep going. The article says the deal struck late last year was one of the biggest ever synthetic risk trade. That's what it's called. Synthetic risk transfer trades, or SRTs. Opaque transactions heralded by Wall Street and approved by regulators that are supposed to hand possible loan losses to hedge funds and other non-bank investors. Yet some buyers in the JP Morgan deal and in multiple other SRT trades borrowed money from other banks to help finance their stakes and inflate returns. Instead of these loans being purchased by hedge funds, the people involved in hedge funds are on their end borrowing money from other banks that are rivals of Chase to take on these loans. That's the triangle that's going on. And that's how this is all going to shake these banks, and it's already shaking these banks. Nomura Holdings, Morgan Stanley, and NatWest Group have emerged as some of the most active lenders to investors in SRTs, along with rivals including Banco, Santander, and Standard Chartered. That leaves them well placed to profit from an expected surge in the deals, but exposed to potential losses if debts end up going bad and the SRT investor hits trouble. When we have this triangle of large banks dumping these risks, they dump their risky loans onto hedge funds and thinking that the hedge funds already have their own capital to take on these loans. But really what's happening is behind the scenes, another bank is footing that bill. This makes that risk even more risky because the money is not coming from the place that it was expected to come from. The article says the lurking presence of Wall Street loans behind some of these complex trades suggests exposures that were meant to be shifted elsewhere remain tied to the banking system. These risks, the plan is to get these risks out of the banking system, but they're still tied in this web. Now, we've already seen a nightmare coming for regional banks regarding commercial real estate, and that is still present, that is still happening, that is still rolling out. So you add to that moves like this of these large banks, these banks that are too big to fail, trying to dump their risks and not really actually dumping them. This is just another way that this banking system is finding itself caught up in an absolute nightmare. And as this happens, this impacts our spot price of silver, because when people realize that their banking system they rely so heavily on is not the safe store of wealth that they thought it was, they're going to pull from that. This is the history of silver stacking, and it repeats itself. They're going to pull from those institutions and they're going to put their money into silver, and that in turn will impact our price of silver. Let's continue. The article says if a bank's lending against the SRT instrument as collateral, you're clearly not transferring the risk outside the banking system. Any counterparty investing in SRT using bank-provided leverage should be prohibited. Absolutely. Period. End of story. It should be prohibited. The article says banks issued about $25 billion of SRTs in 2023, partially offloading the risks of $300 billion of loans. Market participants surmise that anywhere between 10% and 50% of the money for these deals could be borrowed, although it's impossible to be certain given the private bilateral nature of such clauses. The web is just so intertwined when banks try to dump these risks when they try to get rid of these risky loans, it's so intertwined that it's often hard to find where the actual capital is coming from. And the part that smells so familiar to us when we think about the great financial crisis is that risky loans like this, when they're passed around, often they get bundled up into other more healthy products, and investors jump in on those healthy products, not realizing that there's a time bomb in there. That's what happened to the great financial crisis, and that's what we're going to start seeing here. Again, as this unravels, people try to jump out. They pull their investments from these institutions, and it goes into the safe store of wealth that I'm holding here, silver, as a true safe store of wealth. If you're enjoying this video, please hit like, please hit subscribe. It truly helps to get this information out there. Let's keep going with this article. It says the U.S. Federal Reserve is very focused on this topic. They want to make sure if a bank issues an SRT, it doesn't just end up transferring risks between other banks. To help pay for these trades, some firms will seek outside financing. Hedge funds usually do so through a class of bank lending known as repurchase agreements, or repos, in which the lender takes the investing fund's SRT securities as collateral. And what they do with it is that seasoned market players fret about potential perils from borrowing on U.S. deals. They don't use repo leverage that could expose funds or investors on margin calls. They try to take this and pass it through as something of less a risk, even though it truly is in its nature a risk. As this rolls out, along with this issue of commercial real estate with regional banks, we just have to cross our fingers and hope. You and I, as regular, everyday people who are not one of these elite bankers that are in control of all this, we just need to cross our fingers and truly hope that this isn't being passed on to regional banks, because regional banks are already suffering with the issue of commercial real estate. So you add these SRTs, and really I'm being optimistic because they absolutely can. These SRTs, these risky loans, absolutely can end up into these regional banks, and that just gives regional banks another reason to topple over.